Welcome to GRE. I'm your host, Keith Weinhold. Are real estate investors greedy by nature? Learn why. In a sense, today's homes are actually half price compared to 100 years ago. Then, results from a huge tenant survey that reveals the amenities that you must give renters or else they will leave, how media headlines can trick you, and more. Today on Get Rich Education. Mid-South homebuyers, they're total pros. With over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your ROI as their North Star, so it's no wonder that smart investors just keep lining up to get their completely renovated income properties like it's the newest iPhone. They're headquartered in Memphis and have globally attractive cash flows, an A-plus rating with the Better Business Bureau, and now over 5,000 houses renovated. There's zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate, while their average renter stays more than 3.5 years. Every home they offer has brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and, wait for it, a high-quality renter. Remember that part? And in an astounding price range, $100 to $180K. I've personally toured their office and their properties in person in Memphis. Get to know Mid-South. Enjoy cash flow from day one. Start yourself right now at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Cape Hatteras, North Carolina to the Cape of Good Hope, South Africa, and across 188 nations worldwide. I'm Keith Weinhold, and this is Get Rich Education. 100 years ago, you could buy the average home with 8 kilos of gold. Today, it only costs you 4. More on that later. But first, as a real estate investor, has a critic or a tenant ever insinuated some form of these two questions to you? Either, is it ethical for you to own multiple homes? Or even, are you greedy? Now, I doubt that you're going to be asked that question directly, but sometimes you can feel that that's the vibe that someone else is on. Well, there sure are greedy people in the world. You could be rich and greedy, or you could be poor and greedy even. The definition of greed is an excessive and selfish desire for more wealth than one needs, often driven by a destructive motive. All right, that's the definition. Like you're willing to destroy other people in the pursuit of wealth. That is rather different than acquiring wealth, which is usually done only when you first fulfill the needs of others. All right, well, say that your critic makes $60,000 per year. Oh, well, then that means that they're in the top 1% of global income earners. Sheesh, then they're like the Jeff Bezos of the developing world. So to help even things out, should your critic have to send half of their salary to Senegal or Mauritania or Burkina Faso? If the critic's home has more than one bathroom in it, or they even own one car, well, then they're fabulously wealthy by world standards. Then do they have to give it away to avoid being greedy? What if they ever worked overtime for extra money? Like, is that evidence of certain greed? All that stuff is ridiculous, preposterous. Amounts don't create greed. Spirit does. There is no implicit Machiavellian intent if you have more wealth than average. Where would you even draw the line? Like, once you hit 7 rental properties, oh, that's just fine, but 8 of them is too many? Or once you live in a home that costs 50% more than an area's median, then is that when it becomes greed? This doesn't make sense. Higher housing prices these past 5 years has to do with the lack of housing supply. And with the abundance of dollar printing, it's those two things. The culprits aren't rental property owners. The culprits are burdensome development regulations and the Federal Reserve printing all the dollars, not your local landlord. Responsible landlords provide and maintain sound housing, and they do that for complete strangers. They're taking a lot of faith. Oh, so then could the tenant actually be the greedy one if they both resent and expect that treatment from a stranger for free? I mean, real estate investors, hey, we take on risk, debt, taxes, maintenance, insurance, market volatility, and we have the responsibility of building and maintaining a good credit score in most cases. I mean, you're the one that's truly invested in the property, not a tenant that can choose to move out in 30 or 60 days. Landlords are a bit like umpires. They're rarely appreciated, and they only get noticed when they do something wrong. I know I mentioned to you before that when I buy a property, pretty soon I casually mention to my tenant that, each month I just have to make them aware. Each month I make a big mortgage payment and I have to pay for property tax and insurance on this place. I mean, it's amazing to see how far that little mention goes with both timely rent collection and that they don't resent you as a landlord over time. See, tenants often don't know this because they've never owned property themselves. And actually, as you know, since I use property managers now, I don't make this mention to tenants anymore. See, to tenants, often it can feel like they're just sort of renting air, and the rent payments they make to you are very visible to them. What's invisible to them are all of your expenses. You're the one, as the investor, that's contributing to communities. You are the good steward of a neighborhood's housing stock, and you provide homes for people who either can't or don't want to buy. The myth of the evil landlord, it really just ignores realities. I mean, mom and pop investors own 72% of single-family rental homes, and the typical landlord owns fewer than 3 units. Many don't have 401ks. I mean, rental properties are their retirement plan. So most landlords, real estate investors, they're not cigar-chomping tycoons twirling mustaches atop piles of gold like Scrooge McDuck. They're regular people. So perspectives like this, that can really help you ward off both critics and unaware tenants. And you know what? Odds are, if they had the opportunity, they would often do the same thing. At a time when pensions are rare and inflation runs rampant, who could blame anyone for seeking assets that grow in value and generate income? Here's what you need to know. Everyone plays the financial game in the context of their own economy. You, your critic, and your tenant. Your awareness and your mindset from listening to this show is merely more broad than others. If everyone understood that being wealthy is actually a choice like you do, we would all be better off. So the bottom line here is that real estate investors are not villains. They're just people trying to build a financial life raft in a financial ocean that is full of icebergs. Rich people aren't necessarily greedy, just like poor people aren't necessarily lazy. Greed exists in somebody's spirit, not in the amount of your net worth or whatever your income level is. All right, well, heading into the summer here, there are more tenant moves than any other season. Rental demand has stayed fairly strong, not super strong, just fairly strong, with rents only up about 2% annually when you amalgamate single-family rentals and apartments. The share of rentals with a concession is dropping because the rental market is fairly strong. And when renters find a place, a lot of them are staying put like it's the last lifeboat off the Titanic. Of course, these are all phenomena on a national level, and each local area is different. I mean, that right there is something that I could say on nearly every episode. With low affordability, the homeownership rate is down, and renter numbers are up. Now, I told you a while ago that it would go down, that home ownership rate, And in the latest quarter ended, that home ownership rate has dropped from 65.7 down to 65.1%. And that might not sound like much, but home ownership down 0.6% in just a quarter. That means that there are at least about 500,000 new renters in America. More renters means more rental demand, more occupancy, and it's crucial for you to know what those renters want so that you can best serve them. Again, you're not greedy. You're trying to serve them as well as you can. Now, Zillow has an arm. It's called the Zillow Group Population Science. It's something I hadn't even heard of until recently. What Zillow did with this group is they surveyed 36,000 U.S. renters of both single-family rentals and apartments to find out what trends are and what renters want. And I read their entire lengthy report, I think it was 40 pages, so that you don't have to. And what I did is I pulled out the most salient pieces to help you attract and retain tenants. And the top 3 criteria that renters really consider essential when deciding whether or not to rent your property are the first thing, and 95% said this, is that it's got to be within their budget. Second at 85%, preferred location. Does that mean near tacos and coffee shops? And then the third most important thing renters consider essential at 84% is the preferred bedroom count. After that, the floor plan and the layout that fits their preferences was most important. After that, it's the preferred number of bathrooms. So note that the preferred number of bedrooms then is more important in making the rental decision than the preferred number of bathrooms, although they both matter. And then after that, in order of decreasing importance, is broadband internet, allowing pets, and having common amenities like a gym, a business center, a rooftop, and a lounge. And those things, those common amenities, they were substantially more important for apartment renters than for single-family home renters, as you would imagine. And here's key. A separate survey question was asked, what is the main reason that you passed on a particular property and decided not to rent it? Number 1, easily, was that the property prohibited pets. The second biggest choice had to do with pets as well. It was that the property restricted the pet breed or size. The reasons that renters passed on a particular property are so centered around pets. What, do pets rule this housing market now? That's kind of how it seems. Now, another thing that this survey revealed is it also seems like the age for doing almost anything in America is up. The median renter is age 42. Did you have any idea there? 42. Probably older than you thought. And the older people are, generally, the quieter they are and the less they move. The most common application fee paid is $50. That's what the survey found. Hey, maybe that's one thing that hasn't been slapped with tariffs. It's an online world. The typical renter surveyed reported taking only one in-person tour. Everything else is swiping, scrolling, or going deep on Google Street View. Basically, what tenants do is they check out everything online, and then once they've chosen the place that they want to rent, they often make that decision right there online, and then basically that one in-person visit is just them showing up to confirm that there aren't any red flags at that place that they mostly know that they want. And this is good for you if you're self-managing and you're showing the places yourselves. I mean, there are just fewer tire kickers than there were back in the day. I mean, hey, talk to your parents. 25 years ago, rental ads were like 4 lines in a newspaper, no photos at all. So tenants then, they had to show up in person to see what a rental place even looked like. Let's look at the percent of renter households in America by household income. Less than $50,000, 57% of renters were in that range. 50 to 100K, 29%, and 100K or more, 15%. As far as how much security deposit you need to give, 75% of renters said their first month's rent was required to secure the rental, and only 25% said that they also had to fork over last month's rent to secure it. In a really strong rental market, you can more often ask for that, both first and last month's rent. to get in. 40% reported getting their entire security deposit back at the end of the rental. I guess the others pay for that mysterious carpet stain. Most pay additional fees on the rental, 58%, and that's things like water, sewer, garbage, recycling, or other utilities, and it even includes payment processing there. Some landlords charge for that. And again, what I'm talking about here is single-family rentals and apartments combined. All right, so more single-family renters are going to pay for separate utilities on top of the rent, of course. About half of American renters have renter's insurance at 48%. I suppose the others are living dangerously. A typical renter uses 4 websites or apps in their search. And as I'm continuing on here with the results from this Zillow rental survey of 36,000 renters, it also showed that the top 3 reasons that current renters say that they decide to stay long-term are, and this is big, this is about your retention rate. 72% stay long-term because they say rental costs are a good deal. That's why they stay. Next most important is quiet neighbors. Yes, no drum kits or free-range toddlers will help. In apartments, one noisy neighbor can upset a lot of tenants, but a noisy neighbor, that might not be a problem at all when people are dispersed in a single-family rental. And then the third most important thing in long-term retention is 68% of renters stay in a unit because they can't afford to move elsewhere. 2/3 of tenants said their landlord or property manager notified them of a rent increase in the past 2 years. 37% of renters said they would be very or extremely likely to buy a home if mortgage rates fell. All right, that's about 3 in 8 renters say that. As far as the length of leases in America, 64% signed on for a 1-year lease, and 24% said their lease is longer than a year. So really, to summarize what you've learned here from that survey is that you need to know your audience. 42-year-olds with pets, and a strong preference for quiet neighbors. Keep your pricing competitive, embrace tech. People want to apply and pay and do things online, and your tenants will stick around longer. You can either give a man a fish and feed him for a day, or teach a man to fish and feed him for a lifetime. Here at GRE, we do both. GetRichEducation.com is where you learn through this very show, and our videos over there, and our blog articles and more. And then GREMarketplace.com is where you take action and see the markets and providers that make the best income properties nationwide. GRE Marketplace is also where you get access to our totally free investment coaching strategy sessions with a real human being that has both an MBA and investing experience. And that's something we added 3 or 4 years ago that really helps you be profitable as an investor, get paid 5 ways so that you can have more income and wealth, and perhaps even retire early. We help you find the right exact property addresses. That's what we help you do. Compared to 100 years ago, homes are half price today. This is fascinating. I'll get into that shortly. I'm Keith Weinhold. You're listening to Get Rich Education. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
What's up, everyone? This is HGTV's Tarek El Moussa. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. The headlines say homes are so expensive that you'd think millennials would be forced to live in IKEA showrooms. Now, a year or two ago here on the show, I think I mentioned to you that at that time it took 8 kilos of gold to buy the average home about 100 years ago, and at that time only 6. Well, today it took 8 kilos of gold to buy an average home in 1920, but it's only 4 kilos now. In terms of gold, homes are half the price today. And I sent you that pretty shocking image showing this in our newsletter a month or two ago. So what in the monetary twilight zone has happened in the past 100 years? Well, a lot of things. The 1913 creation of the Federal Reserve inflated away your dollar's purchasing power over time. This was basically like giving your teen a credit card with no limit and hoping for the best. Then, removing the dollar's last link to gold redeemability in 1971, that freed the reins for unlimited dollar creation. And Robert Kiyosaki was here to discuss exactly that on the show with us on episode 358. Go back and listen to episode 358 if you haven't heard it and you want to. Before long, dollars got so flimsy that dive bars started stapling them to the wall as decor, and it seems like the next stop for the dollar is kindling for your backyard fire pit. Now, there is, however, an affordability problem today that keeps renters staying as renters. But part of the calculus here is that homes only seem expensive because their values are usually compared to dollars, but that's faulty because dollars are a moving measuring stick. This is like saying that an hour has 60 minutes in it this year, and next year it'll only have 55 minutes in it. That doesn't work. I mean, sheesh, in a few years, everyone would run a marathon in under an hour at that rate, okay? So changing the measuring stick defeats the very purpose of a measuring stick. Here's what's even more amazing than that fact about the gold. Despite that homes only cost half as much today as they did in 1920 in terms of gold, you also get more home today. Today's homes have smaller lot sizes, smaller yards, but otherwise they have amenities that people couldn't have even dreamed of in 1920. I mean, this is really interesting. Let's compare a typical 1920 new home to a 2025 new home. We've gone from 1,048 square feet up to 2,411, so the size has more than doubled. Back then, there was no garage. Today, you've got a heated garage. Back then, you had one bathroom or even an outhouse in 1920. Oh, today you have 2 or 3 or even more indoor bathrooms in just the average new build home. Back in 1920, you had a wood-burning stove that you had to keep loading, and you're like splitting and stacking firewood and storing that somewhere. Today, you have central heating. Just push a button. Back more than 100 years ago, you had no AC. Today, AC is completely standard. You had no insulation a lot of times in 1920 homes. Today, you've got smart insulation. You used to have a very basic kitchen. Today, you've got a center island and granite and quartz countertops. You had an ice box back in 1920 and a nice refrigerator or two today. Back then, you had no dishwasher or garbage disposal. Today, you have both. Back in 1920, you had to use a washboard and a wringer to wash and dry your clothing. Can you imagine that? Today, you have a washing machine. You had an outdoor clothesline back then. Today, you have a dryer. Back in 1920, you had these clawfoot bathtubs and often no shower. Today, you have both bathtubs and showers, and several of them. Back then, you had nothing, where today you have a dedicated laundry room and a lot of times a home office and sometimes even a gym. I mean, so all those changes right there over the last 105 years, this really puts the exclamation point on the fact that homes are cheaper today. In terms of the value that you get, today's homes might be a third or a quarter of the price that they were a century ago. You can't point to mortgage rates either. They're still below their long-run average of 7.7% per Freddie Mac. The thing you've got to point to, the big problem here, the elephant in the room, is that salaries have not kept up with inflation, and that is the real crux of the problem in hurting homes' affordability. Look, and this could be a real epiphany for you here. That affordability fact is even more reason to move today's depreciating dollars into real assets and move that with emphasis and with urgency. Dollar savers are just such massive losers. All right, so then what is the opposite of saving dollars? Some people think it's spending dollars. No, the opposite of saving is not spending, it's borrowing dollars. That's how you go negative on that. The opposite of spending is not saving, it is borrowing. That is how you go negative and short the falling dollar. This really, it's all just a fresh approach on what people need to consider doing. Borrow dollars, own income property, let tenants pay your debt, let inflation also shrink your debt like a cheap shirt that spends too much time in a clothing dryer, and just watch inflation pump up your asset price at the same time. Now you are just winning all over the place. You are racking up more wins than Novak Djokovic at the Australian Open. That's why I am resolute about saying what no one else out there says. Real estate done right is not an inflation hedge. A hedge is a defensive investing strategy where you break even. I mean, no one plays a game hoping for an outcome of a tie. Spending money is an inflation hedge. That's why I refer to borrowing for income property as inflation profiting. That's the reason why. And see, other people's money pays down your debt. Both the tenant and the inflation are whittling that away for you. Oh, and hey, for my fellow math weirdos, in 1920, a new home cost $6,300, and there are 35 ounces in a kilo of gold, and you can figure out the rest from there to see that homes cost half as much in gold now. The bottom line here is that the real estate market is not broken, the dollar is. And that dollar measuring stick is so miserably distorted and perverted that some people can't even see what's going on anymore. I've got another interesting way of helping you see this. Let's look at something more recent than 1920. Let's go back 30 years. Do you have any idea what the median U.S. home price was then? Any guess? 30 years ago? That's kind of charming. It was a modest $130,000. All right, with an 80% loan and zero principal paydown, your mortgage balance would be a featherweight $104K today. That is a clear way of seeing how inflation debases your debt. And of course, the tenant would have paid it off for you by now as well. But I mean, a loan balance of $104,000 without any principal paydown? Sheesh, that's less than some people's American Express card limit. Really, think about that. By removing the principal paydown component, you can really see with transparency and lucidity the effect of inflation whittling down a loan balance to $104K, and that is just 25% of today's median home price of $416,900. That is a stark example of inflation profiting, how your debt got relentlessly debased by the Fed. And of course, rental properties tend to be less expensive than this median number that I'm talking about. So the typical rental property in this scenario, you might just have a loan balance of $75K today here, 30 years later, and the property would be worth, say, $300K. Inflation makes your loan balances feel like a featherweight over time. All right, now let's go somewhat further back in time again. 1950s Florida. Last month in our newsletter, I sent you those fascinating old newspaper clippings from a real estate sales ad from 1955 in the Miami area, and a 2-bedroom, single-family home, 1 bath, screened porch, and a carport. Its price was $7,450 for the entire Miami area home, and the ad also showed that your monthly payment is $48. And then, okay, so that was a 2-bedroom single-family home. This Miami area, 3-bed, 1-bath home with a screen porch, $7,900. So only an extra $450 for an extra bedroom. That is the purchase price of the entire asset, and the monthly payments on this 3-bedroom are $50 a month, a little more than the $48 a month that it was for the 2-bedroom. And here's the thing, the monthly payment amount, as shown in this old newspaper advertisement, $48 and $50, that was principal, interest, taxes, and insurance, all together. A jaw-dropping sub 8K for a Miami area home. Not just Florida, but pricier Miami. I mean, can you imagine a Florida couple's home buying conversation in the mid-1950s there at Florida? Honey, you're crazy if you think we're going to pay an extra $2 per month for a 3rd bedroom. I mean, this is just astonishing. And yeah, my apologies for leaving you flabbergasted so many times in one episode. Gosh. Now, to be sure, wages were lower back then, but back then, only one parent had to work. They still managed to buy homes, raise a family, and even pay for a milkman who actually delivered the milk. And now, if we fast forward to the future generations, they're going to marvel at today's incredibly low median home price of $400 to $450K. Yes, therefore you will be the one doing the flabbergasting, and you'll leave people from 2070 feeling abjectly flabbergasted when the median home price is $4 million then. I mean, it realistically could be. It could be more than that. It's the same way that today we're astonished at 1960s McDonald's menus where a burger was 15 cents. Yes, 15 cents is seriously how much a McDonald's hamburger cost in the 60s. And of course, this is when restaurants also served real meat and French fries cooked in tallow rather than seed oils, and shakes had real cream in them. That's all evidence of simultaneous skimpflation. But getting back to the monetary inflation, as recently as 2011, we can even feel dazed and amazed about how the median home price then was just $211,100. Yes, as recently as 2011. You're surely dazed and stupefied here. One thing I know, though, is that this did not leave you slack-jawed, because between you and I, we know there's only one slack-jaw between us, and we know full well that that's not you. The bottom line here is that zooming out over time reveals a clear, uncomfortable truth. Savers get roasted. Borrowers get rich. This is just a new way of looking at it. And if you're a newer listener and you don't get our newsletter yet, it is free, full of value, and I write every word myself. There are more AI-generated newsletters out there. That is not what this is. This is me to you. And to get the newsletter right now, text GRE to 66866. We don't send you a bunch of texts. That would be intrusive. It's an email newsletter. You can get it by texting GRE to 66866. Now, earlier this year, I talked with you about how home sales have crashed. When people read a media headline like that, home sales crash, some people think that home prices are falling, but that's not what that means. As you know, it means that the quantity of sales has fallen, a lower transaction volume. With that in mind, to help you out in the future when you're reading real estate and economic headlines, I jotted down a few fictitious headlines here, but yet they're the same type that you've seen before, and you'll see these again in the future, and they can be misleading. So let's straighten this out. Okay, here's the first fictitious yet realistic sounding headline: what people often think it means and what it really means. Developer uses tax loophole to deliver 200-unit apartment complex. All right, now some people read that and they think that the developer is doing something nefarious or underhanded. No, sometimes reporters use this word loopholes to describe legally created incentives to get much needed housing built. Reporters are often doing yeoman's work on behalf of NIMBYs. If this thing is producing more housing, then we need more loopholes, which are really incentives, just like it. Here's another misleading headline. Now, almost all of the 50 states have a lower level of housing inventory than they did pre-pandemic, but this headline says Tennessee housing supply 4% more than pre-pandemic levels. All right, some might see that headline and think, oh, I guess that housing is a little oversupplied now. No, not necessarily, because most states had a scarce supply of inventory even before the pandemic hit back in 2020. The next headline is existing home sales fell off a cliff. All right, did you note that this only includes existing homes, meaning resale homes? Because again, the headline is existing home sales fell off a cliff. So this doesn't include new builds. And there's nothing inherently falsified about some of these headlines, they just get misinterpreted. Softwood lumber prices hit all-time record high. Okay, well, with persistent inflation, this might not be reason for alarm. Is it even an inflation-adjusted high or not? Here's a headline: California leads the nation in out-migration. All right, some people see this and assume that the California population is dropping. Well, maybe, maybe not. Again, the headline was California leads the nation in out-migration. Well, raw numbers aren't per capita. Cali is the largest state by population at almost 40 million. And also, if their in-migration exceeds this out-migration, well, then they had positive net migration. And all of this doesn't even count births or deaths. You'd have to factor that in as well. The next headline is foreclosures spike 50% year over year. Ooh, that sounds bad. And although this is a fake headline, just like the other ones that I'm telling you about, a phenomenon like this did recently occur, actually, but it's still at a really low level. It just rose from an extremely low level, 0.2% up to 0.3%. That's a 50% gain. Here's a headline you might see: mortgage rates have dropped 2% this year. Maybe you'll see that in the future. Most people read something like this and they assume that real estate values will resultantly soar. Well, maybe, maybe not. It sounds like homes are more affordable, and they would be, but the Fed might be cutting rates because the economy needs the help. It could mean we're in a recession. So if wages are down, even if mortgage rates are down, it might not actually be less affordable. The next fictitious headline is Philadelphia new build home prices surge 8%. Oh, you're thinking that's got to be good, right? Well, I don't know. What if new build Philly homes are constructed with 10% more square footage this year? But the price is only up 8%, so they're actually selling at a lower cost per square foot. And this is also why existing home price change is more meaningful. The next fictitious headline is unemployment claims jump 30% in a week. All right, well, this usually doesn't mean that there are mass layoffs and some economic Armageddon. If initial jobless claims rise from 200 up to 260K, that's a 30% jump, but it's still low relative to recession levels, which are typically 400K plus. And the last fictitious headline: Warren Buffett, B-U-F-F-E-T, invests $10 billion in apartment REITs. Oh, well, Buffett was spelled with only one T. Buffett should be spelled with a double T. Have you ever noticed that? It is the most frequently misspelled name in financial media. That's all for the headlines. So, having the wherewithal about these sorts of things can help you better interpret what's happening in real estate's future and the economy's future. One of the most inexpensive national markets, I'll say outside the Midwest, where you can own income property, where the numbers really make sense, an investor advantage place, is in the state of Oklahoma. Some of these Oklahoma properties that we've begun dealing with here, they're pretty small. Like, check out this single family rental I want to tell you about that's just 864 square feet. More tenants desire this type of housing. Family sizes are smaller today, yet they want separation and the privacy of a single family home. And this one is brand new build, 2 beds, 2 baths, and the price is, get this, $155,000 for new build. Yes, you heard that right. And the projected rent is really strong, $1,250. I mean, this sort of cottage-sized new build home is the type of product that can make the best rental. Because if it were double the size, you might only get 50 or 60% more in rent. Now, there's no garage on this new build 155K property, and you get all the finishes that you would expect from new construction. The second Oklahoma property to tell you about is this Tulsa duplex. This one really stands out, and Tulsa has over 1 million people in the metro. It was built just several months ago, $2,900 rent on a purchase price of about $360K, and these ones, they've consistently appraised in the $375 to $380K range. So you could very well get some built-in equity here with this duplex where the numbers work pretty well as it is. Each side of this new duplex has over 1,300 square feet, 3 beds, 2 baths on each side, free management the first year, $3,000 cash to you post-closing, all the nice finishes you'd expect with new build in this Tulsa duplex. So these two properties I've discussed here are really investor advantaged, all new build, and that 155K single-family rental was in Chickasaw, Oklahoma, and then the Tulsa duplex in the mid to high 300s. The next one is the last one I'll mention. It's not as good of a deal, but it does look nicer because it's a brick-faced, new build, single-family rental for $320K in Lawton, Oklahoma. Lawton is more southwestern Oklahoma, with $2,400 rent, and it's 1,800 square feet in this new build, and just a little positive cash flow. The property tax rate is 1.1%. Property insurance is just $1,250. A 2-car garage, all the types of finishes that you would expect with new build. So a property like this is if you're looking for a better quality tenant. Oklahoma City has had more happening than usual. You might have heard that the tallest building in the United States is planned to be built in Oklahoma City. Yes, taller than anything in New York or Chicago. The Oklahoma City Thunder NBA team has been performing well. Those things are merely interesting and have almost nothing to do with the investor advantage rental properties. Again, all three that I mentioned there are new build. Not only are we in this persistent national housing shortage, but these entry-level homes that make the best rentals, they're the ones that are in even shorter supply. That's a fact I probably don't mention to you often enough. The home ownership rate is down because of strained affordability, so you may very well have a long-term tenant in these properties, and then you layer on the fact that they're new build, and it really looks promising for tenants wanting to stay for the long term. Check out the market and the provider. Learn more at either gremarketplace.com/Oklahoma City or /Tulsa. Yes, new build Oklahoma properties. If you're not sure about the exact address that's going to provide you with the highest returns, our free investment coaching can help you with that as well. Borrow dollars with long-term fixed interest rate debt that both tenants and inflation just relentlessly pay down for you, while your expected price appreciation can leverage dollars at the same time. Start at gremarketplace.com/Oklahoma City or/Tulsa. Until next week, I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's Experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.